As Steve mentioned, my name is Kim Gardner, and I am a local CPA here in the area. So it is this time of year that I'm either in the office doing taxes or somewhere talking about taxes. So taxes are kind of my life right now. But it kind of makes me popular this time of year. But that's as long as I'm giving the good answers, because no one really likes to pay taxes. So as long as I tell them the good news, then I'm great. But if not, then I'm not their best friend. But I'll go over some of the basic concepts with filing your taxes, basic income tax principles, I guess, today. And these will mainly be regarding to the federal tax return. Each state is different, and so we won't spend a lot of time focusing on the states, but we will go over some of the federal basics. And we'll get into a lot of detail. There are so many details involved with the federal income tax laws, but I'll try to give you a basic framework. As you've been going through these Moneywise workshops, there's been a lot of focus on the financial perspective, the religious perspective in the gospel, the importance of budgeting and planning. And so I want to make a few comments regarding that, and then we will go into the actual tax rules and some of the credits, deductions, shelters and savings, and then briefly at the end we'll talk a little bit about estate planning and wills. So first of all, there's a quote here by President Ezra Taft Benson. And at the end of this quote, he says, plan your financial future early, then follow that plan. And that's one of just the important things that you're doing. The important thing that you're doing right now is that you are planning your financial future and you are making those adjustments that you need to make. And one of the things that he mentions in here as well that says, be even more cautious about get-rich schemes, mortgaging homes, or investing in uncertain ventures. And it is really hard for me when I have clients come into my office when they have large investment losses, but it's even worse when they have these large investment losses with money that they've borrowed. And so now they have the loss and they're actually paying on this large loan. And so the important thing to do is, following what we just learned in the last module about planning your investments and being wise in those decisions. And then a brief comment about budgeting. Elder Marvin J. Ashton, he says that those who avoid the inconvenience of a budget must suffer the pains of living outside of it. And this is a principle that we're all used to in the gospel with the commandments. We know that many people may look at a commandment and think it looks restrictive and not very fun, but that there is a lot of peace in living commandments. And that's how we can look at budgeting. There are restrictions. You do have to make decisions on cutting different wants. But once you're living according to that budget, there is a lot of financial peace involved in being prepared. And I am an accountant, and I like to reconcile my accounts, but it's more of a let's watch where it was strategy, and that's not necessarily budgeting. But I'm trying to make improvements on that, and we don't start small. Even if it's just doing a budget for a month, and then continuing that on and continuing that on to the next month. But those are a few things that are important, and taxes need to be considered into this planning, into the budgeting, and it's something that each of us, no one can get away from it. Some people, do benefit some years where they don't have to pay income taxes, or they even get a refund on some of the credits that we'll talk about. But in general, we're all affected by taxes, and even if you're not paying the income taxes, you are paying payroll taxes, which we'll talk about as well, that are taken from your paycheck each month. So those are all things to consider as you're doing your planning and your budgeting. And here, everybody talks about the weather, but nobody does anything about it. And taxes are something that you can plan for, and you can make some of those changes. And even if you are not in a financial position right now where you can adjust your situation with different tax planning methods, it is something you can still plan for to know what to expect. And as I looked at this picture of this game of life, and referring to taxables as a game, I thought, well, it's not always the most fun game. I can think of things that are a lot more fun to do than taxes, especially in March when I'm looking at a lot of tax brackets. I decided last year that I much prefer the NCAA March Madness brackets compared to the tax brackets, but here we are learning the rules of the tax game, I guess. So there are two different slides here, and I guess I can do this individually. And depending on what kind of a learner you are, whether it's a visual learner or a mathematical learner, there is a slide here for both of those. But I'm just going to go through the basic framework. This is as if you were kind of looking at a basic 1040 tax return, the individual tax return, or maybe even the 1040 easy for really basic tax returns. And you start with your gross income from all sources. And when you're considering what is gross income, it pretty much includes most everything. If you earn something, then you are likely responsible to pay taxes on it, and you need to report it in your gross income. I do get asked quite often if gifts are taxable, and if you do receive a gift, they are not taxable, and you do not need to include that in your gross income. That is kind of taxed on a separate system based on the donor and what gifts they give during the year. So you start with your gross income, and then you subtract adjustments to the gross income, and that's where you get to your adjusted gross income. And that's a term that you need to kind of just stay familiar with. The adjusted gross income, a lot of the limitations for the credits and the deductions are based on your adjusted gross income, or as I'll refer to often tonight, your ATI. So that's something a term that's used often. And then you would subtract your standard or itemized deductions, which we'll refer to a little bit further. Then your exemptions. Your exemptions is an automatic exemption that you get for each individual on your tax return. And then you get to your taxable income, you look up your tax, you subtract any credits, which we'll go over further as well, and then you get your total tax owed. And once you have your tax owed, then you would subtract any estimated payments that you've already paid in, or had withheld from your tax return. So here is just the mathematical. I'll just kind of go through this quickly. You can see here that we still again have your gross income, your above the line adjustments to get to your adjusted gross income. And then here it shows the personal exemptions. It's $3,800 in 2012, so that's for the tax return you're filing right now. And you're just calculate your tax rates, your credit to get to your refund. So there's the two methods to look at that. I'm going to briefly give a few definitions here, then we'll go back to that last slide. But just to get used to a few of the terms that I'm going to be using quite often tonight. Tax deductible refers to subtracting from your income on the tax return when you're calculating taxes. So you often hear, is this tax deductible? And that's just all you're saying, they asking there is, can I deduct it from my income before I calculate my taxes? Pre-tax is something that is subtracted from your income before you even report it on the tax return. So the gross income that we started with, Pre-tax deductions are not included on that. And a few examples of pre-tax deductions would be the 401k, that plans that we just talked about in Module 3. That would be the traditional plan that you're using as a current deduction. Or health insurance that's withheld from your paycheck. Those amounts, those are pre-tax deductions, and your employer will subtract that from your gross wages on your W-2. If it's tax deferred, it means that it's taxed later rather than right now. So it will be taxed eventually. And that's, again, that's with your traditional 401k plan, where it was a pre-tax deduction. You didn't pay any tax on it now, but in the future, you will have to pay tax on it. It's not tax-free. A tax credit is a dollar-for-dollar reduction of your taxes. And I'll go back to the previous slide to show the difference between a tax deduction and a tax credit. And then after tax, it's subtracted from income after you calculate your taxes. And so I'm not sure why they call it an after-tax deduction, because it's not a deduction. But that's what your Roth 401k or your Roth IRA would be, is that after tax. And then if it's tax-free, it's not taxed at all. But let me just go back to this example right here. And everything is, so you'll see the adjustment right here of $1,000. So if you have a tax rate of 10%, an adjustment gets you a deduction of you save about $100, because you save the 10% of that $1,000 deduction. With a credit, you are actually saving dollar for dollar. So if you have a $1,000 credit, you are saving $1,000. And so you can see the difference here. The refund is $550 compared to the $1,450. So it's about a $900 difference when you're looking at a tax deduction versus a tax credit. So with the U.S. tax system, there are a lot of things involved, and which is why it becomes so complicated. And if you follow politics, you'll hear a lot of these I guess social objectives thrown around in the news quite a bit, of the determining factors of what the tax laws will be. And this past year, I followed politics a lot closer than I had in the past with the presidential election, and the tax laws didn't even change until, they didn't make final decision until late December, early January. Some of those retroactive for 2012. And so many of you may have been able to file your taxes now, but tax filing was delayed, and there are still certain forms that we can't file yet because of the late decisions with Congress. But a few of those tax incentives or I guess the social objectives that drive tax incentives, one would be home ownership. A few of the things that you might see are, the home mortgage interest is a tax deduction, and that is to encourage purchase of homes. A few years ago, we actually even had a first-time home buyers credit, where they gave first-time home buyers an $8,000 credit, just to kind of try to improve the real estate market and to encourage home ownership. There's also the real estate taxes that is a deduction. With education, there are quite a few incentives there. There are the education credits, which will go into detail, tuition and fees deduction, student loan interest adjustment. You'll see with charity, the government allows us to deduct our gifts to charity, and to those nonprofit organizations that are doing good and kind of doing some of those things that the government would do if they weren't there to do that. And so they encourage charitable giving. And that is something that even this morning I read, that it's still kind of in the discussion of, I don't think that they'll do away with that completely, but that is something that's been discussed of limiting in the future. Then retirement savings, they're encouraging us to save for retirement by the retirement savings credit, as well as the pre-tax options. And then one we hear all the time is welfare, paying taxes to provide for the needy. So a few things about tax withholding. This one here. The IRS requires employers to withhold taxes, and so that is something that, for those of you that, I know a lot of you are students, but for those of you that do have jobs, or I'm sure you've had jobs at one point, the tax withholding is required. And part of that tax withholding is the Social Security tax, which it's often termed a payroll tax. It's the FICA and the Medicare. And those withholdings are not, they are mandatory. And so you don't have the ability to adjust those. And one thing that you may have noticed in 2013, although the income tax rates didn't change for most of us, unless many of you are above that 250,000, 500,000 wage limitation, the payroll tax did change. And because the reason for that is that there was a payroll tax holiday the last 2 years, which they gave us a 2% decrease on our payroll taxes, and that ended. And so now we're back to the regular rates we were a couple of years ago, and so now you might notice that the amount you're bringing home in wage, your take-home pay is a little bit less. So you're withholding your federal and state taxes, and that is, what you're doing is you're prepaying the amount that you would owe in April. And you decide how much you're going to have withheld, and you normally do that when you complete the W-4 form when you're first hired, but you can also change that at any time. So if you decide that each year your refund is really, your refund is really large, and you'd like to have more of that during the year, or on the other end, if for some reason you're ending up paying and all of your friends are doing large refunds and you're wondering why that is, it's usually the amount that you're having withheld. And so you can go and change that any time with the payroll department and complete a new W-4. And so the concept with that is that the more exemptions you claim on that, the less tax is withheld. And the reason for that is when you have the higher exemptions, when you're married and you have a few kids, you normally owe less tax because the income tax rates are a little bit better. You have more exemptions on your tax return. You often have the child tax credit. And so when you're in those situations, you normally want less withheld during the year than not. So that is something that normally when you're talking to people, that's normally what people talk to when they're talking about filing their taxes. They say, I just filed my taxes and I got a great refund. I got $3,000 refund. And the neighbors say, well, I had to pay $100 and we are in about the same situation. Why is that? And it's mainly this idea of withholding. And it's the term most people pay attention to. A lot of people don't really pay attention to the amount of tax they actually owed for the year. The total tax, they normally just look to see, okay, what do I owe additional or get a refund back? So the goal is to kind of have that balanced out. If you do, I have some clients that they have really large refunds each year, and I talk to them about adjusting their withholding to keep some of that. And that's their way of kind of saving for their family vacation. But that's not, as we just learned about investing, that's probably, the IRS does not pay you any interest for holding your money. So that might not be the best choice to do, the most, the best investment vehicle to choose. But there is an Irs Withholding Calculator on the IRS website. And they kind of walk you through how many exemptions you'll need and help you choose what you should do for your withholdings. So here's an example. Jack and Jill both have $30,000 adjusted gross income. So everything is the same, but they're keeping their tax owed. They both owe $1,050. But then when they take the amount they already paid in for their taxes withheld, that's what determines whether they owe or whether they get a refund. So I am going to talk a little bit now about some of the credits that are available. There are quite a few credits available, so we'll mainly just focus on a few of them that may be more applicable to you right now. First is the education credits. There are some really great education credits right now that are available. And the first one is the American Opportunity Credit. And this used to be termed the Hope Credit, if that sounds a little bit more familiar to you. And it is the most preferred credit. But it's only available to students in their first 4 years of post-secondary education. And so if you are a graduate student, it's no longer available to you, but for those first 4 years, it's available for qualified expenses. And that is books, supplies, equipment, and what the regulations say is that those need to be required course materials. And so those all can be included in your qualified expenses, and the credit is $2,500 maximum per student. And how this is calculated, it's actually 4,000 of qualified expenses, because the first 2,000 of qualified expenses you get 100%, and then the next 2,000 you take 25%, and so that reaches your maximum credit of 2,500. And this, you can include the payments that you make with a student loan, because you borrowed the money, so that's now considered yours. But if you are paying your tuition with scholarships or Pell Grants, you're not allowed to take this credit, because you've received that income tax rate. Yes?
So it's maximum. What keeps a student from getting below 2,000? If you paid well over 2,000 in school, what keeps you from getting at least 2,000?
Okay, so what keeps you from getting at least 2,000? If you qualify for the credit and you have paid at least 2,000 in expenses, you would get a $2,000 credit.
Okay, some of the self-service ones like TurboTax, because of that, will not give you above 2,000.
It could have been if you didn't owe that much tax, because there's a portion of it, 40% of the credit is refundable, but 60% of it is not. And so it's limited by the actual tax you owe for the year. And that might be part of the reason. Yes?
If this is for the first 4 years, is that 2,500 max over the 4 years, or is that 2,500 for each year?
Okay, so the question is the 2,500 over the 4 years or for each year? And the 2,500 credit is actually each year. So it's an annual credit for students. And so if you and your spouse are both students, it's $2,500 for each of you. So, and one thing to keep in mind with these credits is that whoever is claiming you as a dependent takes these credits. And so if you are still being claimed by your parents who are providing more than half of your support, then they would be the ones that would be claiming this education credit on their tax returns. So if you don't qualify for the Hope credit, the next best thing is the Lifetime Learning Credit, and this is available for all education, for any number of years. It's not limited to the first 4 years, and it is 20% of the first 10,000 of expenses per family. And this credit, you can take this credit or the Hope credit, but you can't take both. So you would want to take the best. If you qualify for the Hope credit, you want to take the Hope credit. If not, then you would you would take the lifetime learning credit. So here are a few other education incentives, and they're listed here with the credits to keep them with the 2 credits that I just talked about. But these are not credits. It's the education expense deduction, and it is an above the line deduction. So that is once you take your gross income, you take this adjustment before you get to your adjusted gross income. And so that's what it's referring to there, that above the line adjustment. So it's $4,000, and you can't take this credit with this deduction and the credit. So again, you kind of look to see what benefits you the most. Yes?
So kind of a side question, maybe most of us are kind of dependents with our parents. So would our parents get those credits, and then when we become independent and we're still in school, can we get those credits?
If you're still meeting the requirements, so for the whole credit, if you're still within your first 4 years of, I guess for school, that's the word, in school, then yes, you can still take that. You can't, like, your parents take it for 4 years and then you take it for 4 years. So you can, as an individual, you qualify for the credit for 4 years.
So if you're dependent on your parents, then your parents get this credit, but if you are independent, then you get this credit.
Right.
Okay.
Yes, so your parents get the credit if they claim you as a dependent. You can take the credit if you are claiming yourself. Another adjustment, again, this isn't a credit, this is an adjustment, is student loan interest, and that is any interest that you have for student loans, taking out for tuition fees, and this also includes room and board. The qualified expenses that we talked about for the credits, they do not include room and board, and then also includes books, supplies, and equipment transportation. There was some talk recently about limiting the student loan interest to $2,500, or that's to 60 months actually, but that didn't go through. But if you heard any talk about the 60-month limit that you can deduct student loan interest, that's not in play right now. So it's up to $2,500 in interest a year, and then there is a phase out. And this is actually, it says $120,000 to $150,000 there at the bottom, but this is actually $125,000 to $155,000 for 2012. And this is one of those limitations that I referred to, that when it says phased out for income, it's referring to your adjusted gross income. So that's why sometimes those above the line adjustments are beneficial, because they lower that adjusted gross income for some of your limitations that come into play. So back to the credits. One of the retirement credits is the Savers credit, and it is it's to encourage your saving for retirement, and it's 10 to 50% of first $2,000 contributed to a 401k, an IRA, or a Roth IRA, and this percentage depends on your adjusted gross income. And most of these tables that are included here are for married filing jointly, so they're different for those filing single. But you'll notice here that once you reach $57,500 in income, that this credit is phased out. So in a lot of the tax returns that I do, once you're established in a career, a lot of times that disappears pretty quickly. But that is an option. It's full-time students are ineligible for the credit, but if your spouse contributes, they are still eligible, and you can get the credit. A few additional credits. The child tax credit, that's a pretty popular one because you don't have to do anything, pay anything. It's really, you just get to recognize the $1,000 on your tax return for children. So that's for children under age 17. So if you're debating to have your child December 31st compared to January 1st, you'd save $1,000 if you had the child December 31st for that year. So another credit is the dependent care credit. And this is a credit that is there to really kind of support those spouses that have to get, those couples that have to get daycare for their children while they're both out of the home working. And also it does, there is an exception if the spouse is a full-time student. So if you have a student and someone working and you need to pay for daycare, this credit is up to $3,000 of qualifying expenses, but the credit is only 20 to 35% of these expenses, depending on your income. And one thing that I've noticed with this dependent care credit is that a lot of individuals are a little hesitant to claim it because they have to report the Social Security number or the employer identification number of the person to whom they're paying the child care to. So if they're just paying their neighbor, sometimes they're a little hesitant to report that on their tax return, that they paid their neighbor, $3,000 to watch their child, because they don't always know if their neighbor is reporting it and different things. But if everybody is reporting it like they should be and working together and everybody's honest and reporting everything, then it's not a difficult credit to take. But I have seen that they've often asked me, well, how much will it really benefit me? Because I have to talk to my neighbor and get her Social Security number, and it's a little uncomfortable for some people. But that is a credit that's available. There is also the Earned Income Credit. The key to the Earned Income Credit is that it is based on earned income. So it is a really beneficial credit for those that are in lower income levels, because it's a completely refundable credit. So even if you don't owe any tax, you can receive the Earned Income Credit, and all of a sudden you have a $4,000 benefit on your tax return. But like I said, it is dependent on earned income, and it phases out fairly quickly. So you can see here there's a little table with a few of the examples of the phase outs. But so if you don't have any children and you earn less than $19,000, you have a maximum of $475. And as the children and as your income increases, the maximum credit you can take increases. And then it starts to phase back out as your earned income gets too high. And one thing with the Earned Income Credit is that you can't have any investment income over $3,200, and you must be age 25 or you can be younger than that if you have a child. And then it mentions here that you can get a partial amount on each paycheck, but that no longer applies. That's outdated. So, but the Earned Income Credit, again, it's to kind of help out those in the lower income levels. Sometimes it's beneficial to students if you have earned income, but if you don't, then it is not as applicable. But a few other credits, I won't go into the details, but there's an adoption credit for those going through adoption. There's also a residential energy credit for energy improvements that you make to your home. They have to make certain qualifications, such as, I don't have all the specifications with me right now, but there's like water heaters and windows and doors, those types of things that meet those specific specifications or additional credits. So if you can't take the credit, the next best thing are deductions. So we'll go over a few of those deductions quickly. But one of the main deductions is the mortgage and home equity loan interest. There's also the charitable contributions that we talked about briefly, and that's cash contributions. So the contributions, such as tithing, but then also non-cash contributions that you would make over at different industries. The property and state taxes are an itemized deduction. Excessive medical expenses, and that amount has to be over 7.5% of your adjusted gross income. And so if you have insurance and you're covered and you don't have as many out-of-pocket medical expenses, then you might not reach that 7.5% limitation. Also, with health savings accounts, those have become quite popular. You can't use the amount of funds that you use from your health savings account as an itemized deduction because you already contributed that money pre-tax.
Question?
Yes.
Can you deduct them from actually paying on like cars and things like that as well, or is it just like your whole investment property?
Okay, so the question is if you can deduct property taxes on cars and vehicles and things. And in Utah, you actually cannot because the taxes on as an itemized deduction they have to be value-based taxes. And Utah now bases a lot of those taxes on age-based. So there used to be a few that you could take, like some of your recreational vehicles, but some of those have changed as well. So there are still a few types of boats and RVs and things, but in general, you cannot do your cars, your vehicles anymore. There is a standard deduction that each individual gets, regardless of what deductions that they would have to report, and that's referred to as the standard deduction. And so if you're a joint filer, that standard deduction is $11,900 for 2012, and that is automatic. And then if you're single, it's $5,950. And so all of these other deductions that we've talked about, the only time that those become beneficial is if they're greater than these amounts. So your question is, are you going to take the standard deduction or are you going to itemize? And you'll only itemize if you have enough. And so if you often, mortgage interest is one thing that pretty quickly gets you over that standard adjustment amount. But if you don't have a home with mortgage interest and the real estate taxes, it's often better to take the standard deduction. But most of the programs that you use, they'll walk you through that, and you can make that decision as you go along, or you can enter in the information, and then they'll tell you what's best. If you only have $4,000, they'll take the standard deduction for you, the $5,950. But the state taxes you had withheld during the state taxes you had withheld from your paycheck during the year, that amount is also included in those itemized deductions that the state taxes paid. So briefly, a few of the shelters and savings plans. We talked a little bit about this in Module 3, and so we won't go into too much detail, but I want to reiterate the point again that the difference between the Roth and the traditional. So when you're making that decision, your Roth is after tax. And so if you don't owe any taxes now, Roth is definitely the way to go. All of your earnings will grow tax-free. And then if you do owe taxes, that's your decision. Do you think you owe more taxes now, or do you think tax rates will be later? Where I'm single and don't have some of those extra exemptions and the higher deductions and the lower tax rates and the child tax credit, I've actually chosen to do a little bit of both because I do want a little bit of that deduction now. So that's something to consider when you're deciding to do that, whether you want that tax savings now or later. And again, take advantage of your employer match. That's one of the first things you should do. And then it's the same with your IRAs, that same decision of traditional IRA or your Roth IRA. And with those, just a note, you can actually make those decisions about your IRA after the end of the year. So for right now, you can still make a contribution for 2012 until your taxes are due on April 15th of 2013. Another opportunity to do some shelters and saving or college savings plans. And just one point is that you're not a bad parent if you're not saving to put your kids through law school. There are important things that you need to prioritize as you're doing your financial planning and your budgeting. There's a few important things. One, is your retirement planning. It would be great to send your kid to school, but are you out of a home with no money at that point? Because that's where all of your money went. So debt elimination, retirement planning, and then if you decide that that's a high priority for you to do education planning, and there are a few options there. But just what it points out here is just to make that plan, decide what you want to do. You may have some different backgrounds. You may have worked through school, and your spouse might have been, their parents might have paid for them to go through school. So you might have some things to just decide there. And then just establish that understanding with your children earlier. Let them know if they need to work hard in school and get a scholarship and do those things. So one of the options for the tax-favored education savings is a 529 plan. And that is the plan that each state has established with an investment company. And you can look at different investment companies and these state plans and decide which one will work best for you. It doesn't determine where the child would need to go to school. It just is really just choosing an investment. And Utah is actually a very highly rated program. And you can find information on that at uesp.org. And there's actually, Utah does a state income tax credit to encourage contributions into their plan. But it's 5% for contributions up to $3,560. So it is a very small credit, but it's a credit. So there's also prepaid tuition programs, and that would be if you were actually prepaying a school now for the tuition rates they are right now. But that would mean that the beneficiary of that contribution would actually have to go to that school. So you wouldn't have the flexibility there. And then there are Coverdell ESAs, which are education IRAs, and you can contribute up to $2,000 per year for students with those, but those are non-deductible. But the earnings will grow. The earnings will grow tax-free. And the difference with the Coverdell ESA compared to a 529 plan is that the Coverdell, that can be used for elementary, secondary, and post-secondary school, where the 529 plans can only be used for those post-secondary. So just a few comments as we close up for questions on estate planning and wills. We won't get into a lot of planning on, what are we going to do with our massive estates at this point in our lives. But just a few things that we wanted to point out is that there are a few things that you can decide now. And one of those things is children's custody. If you have children, that's a really important thing to consider, is who you want to take care of your children if something was to happen to both of you. And without a valid will, the court would decide who would take care of your children. And so that's one of the priorities at this point of your life is what to do there. And then also to look at what assets you do have and what you want to do with them. They can be massive assets to really small assets. Across the board, but there are certain assets that already have beneficiaries in place without a will, such as insurance policies and retirement accounts. But for those other things, such as homes, vehicles, homes, vehicles, and joint account transfers, they transfer to the surviving owner if something happens to just one person. But then other than that, you would need to distinguish according to a will. There are three alternatives to a simple will. The first option is a holographic will, and what that means is that it is just a handwritten will in your own handwriting, and it doesn't need to have witness signatures. It can be done right now. You and your spouse can sit down and make those determinations. And you can also look at will preparation software. And one thing that I've been hearing conversations about a little bit with my friends lately is the living wills. That's something to consider as well. If something's to happen to you now, how do you want to be treated? Do you want to be left on life support over a certain amount of time, and different things like that? There's different decisions you can make now on how your family members would handle your health care if something was to happen to you. And then also you can, you have the alternative of seeking an attorney. So just in summary, I just want to point out again the importance of planning and budgeting and setting those goals down and learning the tax rules. There are some simple basics, even though, there are a lot of laws that get complex and a lot of things to remember. There are certain basics that you can remember. And look at your tax withholding, decide if it's a good amount for you during the year. And then look at the list of credits. There's on the IRS website, just at one of the top tabs, there's deductions and credits, and you can click on that, and it will give you some of these credits we've talked about. Will give you a little bit more detail there. And then also, again, deductions. What are your priorities right now? Is it retirement? Is it saving for retirement? Is it saving for college education of one of your beneficiaries, whether it's a child or a grandchild? Shelters and savings funds. What you want to do with your, regarding 401ks and IRAs, and those can always be changed, and that's always kind of a constant question on my mind. It's always, like, deferring the correct amount at work. Do I need to go set up an IRA? And those questions you can always adjust those as your situations change. And then I look at long-term planning. So a few FHE suggestions. We've just talked about that a little bit. Reviewing the list of credits and deductions. Look at your withholding. Get out some sheets of paper and write a holographic will. And decide if you're to a point where you actually would need to seek an attorney to get a will. But those are a few suggestions. And then here are a few resources. And the one thing that I want to point out on the website is the free income tax help. How many of you have used the Vita Lab here in the Tanner building, or I guess have worked at it? So quite a few of you. So there is the Vita Lab that's available. It's a voluntary income tax assistant. There is one here in the Tanner building. It's open February 4th, and it will stay open until March 29th. And you can go online to the website listed in the materials, vita.byu.edu, to set up an appointment, and they can help you there. There's also more options of voluntary income tax assistance on the IRS website. And also, if you're under certain income limitations, they have a list of free e-files, programs that offer free e-filing, and you may have to pay a little bit for the state filings, but the federal, those are free. So I hope that gave you a little bit of some basic understanding, and then I'm happy to answer any questions if you have any of those you want to come down and ask. And then there's also the representatives here from the class that are sure happy to answer questions